Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Thursday, March the 13th, 2025, recording this in the morning. Okay, so yesterday, a bit of a sort of a choppy session overnight, not a huge amount of, sort of news or big market moves. I think what we have to be looking at today is the PPI, which often is a secondary kind of event. But yesterday we had the CPI, which on the face of it looked, sort of relatively sort of positive in the sense that it was sort of lower than expected. You can see here that if we look on the month-over-month headline, we came in at 0.2, much lower than expectations and last time. And the same here for the month-over-month core number, which came in lower than expected, and also the yearly numbers. So that all looked pretty good. But we didn't really see any sort of rally in stocks, and we didn't see any sustained rally in the bonds. And that's just because once traders started looking at the subcomponents, it seemed that a lot of these sort of more negative numbers had been caused by sort of a slowdown in the pretty volatile sort of airfares kind of section. And so the reality is that a lot of the subcomponents which feed into the PCE, which is, of course, is what the Fed is more focused on, they actually were a little bit sticky, things like shelter and whatnot. So the point is today that traders want to have a second bite of the cherry, so to speak, or a second look at the data. And that's why the PPI today, which is expected essentially at 0.3 here on the monthly numbers, people want to see if basically that comes in lower than expected. If it doesn't come in lower than expected, then that could mean that the PCE not only is sort of stable and sticky, but maybe even is trending upwards just a little bit, which obviously is not what the Fed wants. So if that's the case, then it's going to be very, very difficult for the Fed to cut. And we have to say at this point that March is probably definitely off the table. And as you can see here, the market's only pricing in 1 basis point, less than 4% chance of cutting. But then really the question is for May. And if we look at actually what's happened just over the last, this is for the December pricing, and you can see here that what's priced in at the moment is about 69 basis points. So that's about 2.5, 2.75 cuts. But what you guys can notice here is that if we go back just like 3 days ago, we can see that the market at that point was pricing in 85, 90 basis points of cuts, well over three. So about three, what's that, 3.5 cuts. And since then, the market has repriced, I don't want to say hawkishly, but less dovishly. And so that whole sort of narrative, that narrative of, the US exceptionalism fading and the US economy fading and everything collapsing, that's basically been a little bit overdone. And I think we've seen the peak of that narrative. And you can see here, this is on a tick chart. So very short term, you can see here yesterday the reaction on the headline number. The algos took this a bit more dovishly on the December pricing, but immediately traders kind of started to sort of trade it a little bit more hawkishly. So the point is that at this, as we speak this morning for December, we have about 2.7 cuts priced, had got out, as I say, to over three. And really what we'll be focused on is looking at May. March seems definitely to be off the table. May at this point only seems to be about a 1 in 3 chance of them actually of them cutting, and only 8 basis points priced in. So at this point, I think, assuming that it comes in line, I think it's going to be difficult for the stocks to rally at this point. We also, in terms of the auctions, let's look at a few charts here. We had a reasonably strong sort of 10-year auction yesterday. We have a 30-year auction just to finish the cycle today at 1 p.m. So if we look at here at some of the yields, which I'll find in a second, just grab some tea. So until we get the auction process finished, let's just have a look here. You see here that yields on the 30 have basically been climbing up over the last couple of weeks. And I think once we get the auction process underway, maybe, if we get something, a little bit sort of further down here, might be interesting as a buy. Other levels to be looking at, maybe on the 10-year, could be something like, maybe a little bit lower on. But basically at this point, the market has decided that, that it needs, sorry, I just lost my train of thought here. At this point, we need to get through the auction cycle. That's what I'm basically saying. Now, if we go to the SPY here, just want to go to the SPX. I mean, what should we be looking at? I'd say that at this point, we're sort of starting to trade in a pretty choppy trade range. We saw yesterday up and down. If we look here at the VIX, we can see that the volatility index here is where are we? Back here, we can see that if we look at the curve here of the VIX, still pretty elevated levels. I don't want to keep on going on. I've been saying this for the last 2 or 3 days, but basically the front end of the curve is still higher than all the way out the curve, so it's still in backwardation. If we look compared to yesterday, we can see that it's even a little bit higher than yesterday. So no great relief there. If we look at 1 week ago, we can see that not a lot has changed. So the point here is that our volatility still remains elevated, still in the mid 20s, which is elevated. And as long as it remains elevated, we're going to get sort of big sort of 100-point squeezes and sort of sell-offs. And it's just difficult to see this market rallying in a structural kind of way. So personally, on the SPX, the cash index, I'm looking at a level of about 56.70, which is this sort of level up here, possibly to sell. As you see, it's like every sort of little, the mini sort of sell-offs are being bought, but any rally is being sort of hit. So just, just finding it very, very difficult to rally. And if you look on a daily chart here, you can see that it's still a heavy kind of situation here. And we're still below all the moving averages, fib levels, et cetera, et cetera. If we go across to Europe overnight, not a huge amount of activity, a little bit heavy, still just trading, a little bit on the heavy side in the DAX. If we look at the Euro stocks, we can see that's also trading heavy. Not that it's collapsing. And I think probably the next direction could come from Germany. We have the Bundestag, which is the German parliament, which is actually debating today the infrastructure and the defense package. I believe that's happening around about 1 p.m. their time, so probably starting to happen now. And the Green Party has still said that they have a lot of problems with it. Listen, do I believe that there's going to be some form of sort of a stimulus and infrastructure spending and defense spending? Yes, that does seem to be the case. Could it be a little bit watered down? Could it take some time to be implemented? Absolutely. And so I think at this point, in order to have the next cycle up in the Euro stocks, we probably need to see some more clarity from the German political situation, and we could have that today because, as I say, they are debating that, and that leads over into the into the bonds. If we look here at the at let's say the Italian bonds, they're still trading a bit heavy, but more to the point, if we look at the German Bund, it's finding it very, very difficult here to gain any traction after that initial big sell-off on the news of the fiscal stimulus. And so what we can see is that around about the 126.60 level, that's kind of like a double bottom here going all the way back to the beginning of October of 23. So, a couple of years ago. It's just finding it very, very difficult. And the only thing, there was some sort of rumors and talk over the last 48 hours, that the spending would be less. So as you can see here, it had a little bit of a rally of 20, 30, 40 ticks, but that was essentially sold immediately. So the German curve, especially the 10s and the 30s, we can look at the Buchsel here, the 30-year, trading very, very, very heavily. And it's hard to see that moving at all. In terms of the spreads, we still see that the Italian-German spread, very, very stable, nothing particularly dramatic going on there. The Italian authorities Meloni continues to say that she believes pan-European issuance would be the most important thing. And the market seems to be agreeing with that at the moment. There's no particular stress on that. So if we just have a quick look again, going back to those US bonds here, as I say, let's say looking at something like the 10-year yield, we can see, as I was saying before, that the yields have pushed up a little bit. They didn't get any relief from the CPI. Today, as I said earlier, with the PPI, we shall see what happens. If that comes in hotter than expected, definitely the front end of the curve will sell off a bit more, and something like in the expectations for the May meeting will probably be taken off the table. And maybe instead of having 2.7, 2.8 cuts priced for the totality of 2025, that could come down to 2.5 or even gradually make its way just down to 2 cuts. Depending on the PPI, if it comes in a little bit hot. The other thing to be looking at for today in terms of the data is actually the initial jobless claims. So there was a lot of talk, over the last couple of weeks, especially. We can see here the estimates here for the initial jobless claims is 225,000. There was a lot of chatter about, DOGE, the Department of Government sort of efficiency cutting government jobs. That didn't really sort of turn up in the initial jobless claims last week. So let's see this week if we start to get these numbers going higher. But as you guys can see here, initial jobless claims 225,000, expected 221. These are still indicating, these numbers are still indicating a very, very, very strong labor market. So no sign yet of either, let's be honest, like of inflation coming down to target, or of the US economy collapsing in terms of the labor market. Yeah, for sure, there's a little, a few sort of cracks here and there. But I think that peak narrative last week of, oh my God, Trump's tariffs and uncertainty is going to be causing a slowdown, that was a narrative which gained ground. And I think the market has just pulled back to a little bit more sort of in a positive way and a hawkish way is what I'm trying to say, just sort of looking at things with a little bit more calmness. But today we do get a little bit more information. Just finally, guys, just want to have a quick look what's going on in the currencies. And we've got like a trend table here from Saxo, which I like to look at. So what we can see here is that the big trends here, this is going back, this is like a volatility adjusted trend. We can see here that gold still positive, but it's lost a little bit of the heat in that rally. So gold just sort of going sideways. Some of the Scandinavian currencies, especially in Sweden and Norway, but especially in Sweden, have been doing very, very well. And that's just based on the fact that in Sweden, there are quite a few sort of defense contractors and heavy industry. And the idea is that they would be benefiting from the increased defense spending and infrastructure spending in Germany. What we are seeing, though, it's interesting, if you look at the commodity currencies, obviously CAD has a lot of ongoing problems with tariff negotiations with the US, but we can see the New Zealand Kiwi and the Aussie dollar still looking pretty much red in terms of the trends. And that's just because we had the 2 sessions meeting in China, which, it gave some sense of a bit of stimulus, but nothing sort of dramatic, no kind of bazooka. And as long as the Chinese economy seems to be just doing okay, and the American economy is, the American administration still seems to want to put global tariffs on. That is bad for risk and bad for the Aussie, the CAD, and New Zealand. And we can see still pretty much in red. We also see that in terms of the trends, the Japanese yen, a little bit of steam has come out of that. It's still, blue and looking a little bit positive, but not nearly as strong as, let's say, a week or two ago. And that's just because we look on the chart, it's reached levels where it's facing a little bit of resistance. Although overnight we did have Ueda, the governor of the Bank of Japan, essentially saying that he did believe that inflation would still be trending upwards. So the market is still expecting a hike or two. So overall, I think the point in Japan is that any kind of big dip in Japanese yen is probably a buyer. What we have seen is that the euro obviously has had a very, sort of strong performance over the last 6 or 7 days, just coming off a little bit, probably just stabilizing. I think structurally the euro still could potentially have a little bit more upside, just sort of stabilizing. US dollar, still pretty weak, still pretty weak. So let's look at a couple of charts here, just to put that in context, just to finish off. So if we look here at the US dollar versus the yen, you can see here that it's just sort of trying to get off the mat here at the 61.8 fib retracement around about the 147 level. Probably there is a bit more downside here, and if it gets up to, let's say, 149, that could potentially be a sell, or certainly up to here 151 or so. But again, the US dollar has come off a lot. If the yields in the US stay high, and if the US economy remains strong, and if the tariff situation, let's say we don't get tariffs which are big enough to kind of really disrupt global trade, but just sort of 5 or 7% symbolically, that could ultimately be could be a strength for the US dollar. So the thing is, the US dollar it is difficult. I mean, my gut is telling me to sell rallies here, but I think it could just sort of range for a little bit, because it's come a long way and just waiting for a little bit of clarity. In terms of the euro, again, that's come a long, long way. At this big overhead resistance at 109.40, it's just having a bit of a consolidation. Listen, I think if it gets back down to 107, that would be a beautiful place for a buy. Let's see if it gets there. And ultimately, where could it go up to? Again, it's going to depend if things go well in Germany, and there's a peace in Ukraine, and the German infrastructure bill goes through, and Trump does not like seriously impose tariffs, we could see the euro push back up, even up to sort of 110 or 111 or so. But just taking a bit of consolidation for the moment. As I said before, some of the commodity currencies like the Aussie here are down a little bit. You see, for example, the CAD, USD CAD, just sort of range trading here. It's being volatile, but finding it difficult to find much strength. Okay, guys, I'm going to leave it there. As I say, main thing today, a bit of a choppy market is just to be looking at the initial jobless claims. We want to be seeing if there's any sort of evidence of government workers being fired. The second thing, of course, is the PPI. If that comes in sort of in line and a bit hot, there could be some sort of chatter that the PCE actually could be going up a little bit, and that could put sort of bond yields, especially at the front end, under a little bit of pressure. We have the auction of the 30-year at 1 p.m., which again, until that finishes, there could be a little bit of upward pressure on the bond yields at the middle, the belly, and also the end of the curve, which probably will support US dollar. The stocks, as I say, are still under pressure. And because the latest thing we have to deal with is that the Democrats seem to be blocking the spending bill. And so here we go again. There could be some possibility of the US government shutting down in April. We'll follow that one as the days go by. Okay, guys, thanks very much. Have a great day, and we shall be talking soon.